Is the GameStop craze over? The company's stock slumped 30% on Monday as online brokers like Robinhood kept some restrictions in place on how many shares investors can buy.
Some traders on social media insist hedge funds are also trying to manipulate the stock price lower and divert attention to other companies. Regardless, the Wall Street showdown is getting a lot of attention, and here to break things down, financial advisor Jeff Massey of Massey & Associates. He's joining us live via Zoom. Jeff, hello.
Hello there, how are you?
I'm doing well, Jeff. Thank you for being here. First off, can you tell those of us who might still be a little bit confused what exactly happened here with GameStop? And was it all really just teenagers on message boards who were responsible?
Well, I don't think it was teenagers per se, but there was a great deal of purchasing that was created through social media that, somebody came up with the idea, if we can push the stock up, we can really damage some hedge funds who short that stock. And the real challenge with that is when a hedge fund shorts a stock, they borrow the stock and then sell it at a certain price, expecting that the price value, the share value will go down, and therefore they make the difference when they actually replace the stock that they borrowed. So they got kind of wrapped up with that. It ran up well over $300 per share, and today closed it at like 90 a share. So it's been a huge manipulation in the market. It's a little scary when you really look at the bigger picture.
Jeff, you mentioned scary, which I think is a good term for most people who aren't familiar with the stock market. So let's talk about the average person here for a moment. Will any of this impact our individual investments, our 401ks?
Generally not, because these are very thinly traded stocks. So they're not typically a stock that's going to be held in a common mutual fund in most retirement plans. So most people are not going to be impacted by this at all. It just, like I said, it's a little scary because when you see a stock that was obviously manipulated, where it went up so high and then it's come crashing back down, a lot of people got hurt with that because that smaller investor that was buying on the way up is now going to lose a ton of money when they're selling on the way down. And that's the real unfortunate part. So it's kind of like a Ponzi scheme. People that got in early likely made a boatload of money. But the people that came in later on, they're going to lose a boatload of money. And that's what really is lousy for the smaller investor that's not really aware of how this all works.
This has even gotten the attention of some lawmakers in Washington, D.C. There's a hearing later this month on short selling and online trading platforms like Robinhood that we just mentioned. Do you think we could see some real change coming from this?
I would like to think that we will, because when you look at it, the hedge fund, in essence, is manipulating the market a little bit because they're trying to drive that stock's value down so they can purchase it at a lower price and then make a profit. And that's the unfortunate part, because if one hedge fund does it, another is likely to follow suit. And then that just creates the manipulation in the market right there, driving the price down. And if you get hedge funds that are kind of colluding with one another, they could really cause some damage to a company just because they felt like targeting that particular company, not because of any other fundamental reason. That's the unfortunate part. And then the website shut it down. Robinhood shut it down, where the small players could no longer play and only the hedge funds could trade. And that's unfair as well. So I would like to see that there are some changes made. The most important part is don't follow the shiny object. Have a plan, and that's the difference.
And Jeff, what you just said may be the answer to this question. Have a plan, of course. It's still worth investing in stocks, or should we be thrown off by this?
No, you should not be thrown off by this, because if you were not directly invested in this stock, you wouldn't be impacted. And there may be regulatory changes that may come in the future, but that would be for everybody's benefit as opposed to a detriment. We are strong believers in having money in two basic positions. You need money invested in the market for growth, and you need money in safety positions to offset downturns in the market like we experienced in March of 2020. That's a huge difference. It's all about balance.
Financial advisor Jeff Massey of Massey & Associates, thank you so much for your insight and your knowledge and for being with us today.
My pleasure.